The reason I picked it is because that it's hard to envision a scenario where it just completely falls out of bed. But the uptrend that's been in place since the bottom of COVID could certainly kind of roll over if you had kind of a deteriorating U.S. energy production, right? So we see, for example, many energy producers are not investing heavily in capex, and you have kind of bottlenecks in terms of allowing new pipelines to be built, and so you could get stagnation in the space, and therefore you might not perform terribly, but you might, for example, underperform the S&P 500, which would be a shame. And so I can certainly envision a number of scenarios that impact it that lead to underperformance. But I think a lot of the crash risk is been removed from that space. Another thing that we're watching is how they're kind of responding. So, for example, in prior years, they used to issue a lot of equity, and they used to be building a lot of pipelines rapidly. Now they've transitioned towards a more self-financing model, so they've lowered distribution yields, and some of them are actually ironically buying back their own units. Right, so they're not even issuing new units. Some of them are actually mildly shrinking their unit count, and so now you're basically expecting slower growth, but you're still expecting decent per unit or per share performance, right? So it's kind of they've rearranged where their expected returns are coming from. So a little bit higher yields due to lower valuations, and then kind of low unit growth or even no unit growth, maybe unit shrinkage, and then kind of very slow increases from inflation and other things like that they can pass on price increases. So I think it's really one of those things where most of your returns are going to come from distributions over time if you hold it long term. If you hold it short term, you have that kind of that mild uptrend in place. I think there's a decent chance on the downside that it just ends up being kind of an underwhelming trade where it doesn't really go anywhere. It's kind of dead money.
And on the upside, Lynn, what targets do you expect this trade to be able to reach over a few quarters down the road, which is your time horizon, if I understand correctly?
So I think EPD could get over 30 and trend towards the mid 30s, and I think AMLP, the ETF, I think could trend towards the mid 40s or up to 50 or so. But that's, you're kind of basing it on investor psychology. What are they going to want to pay for it? So I think that they are worth those numbers now. But the question is, what will the market pay for it? And so if you have a broad market downturn, you know, you might not hit those targets. You might just chop along. You might hold up better than the market, but you might not reach those. I think the best thing about the trade is that it should be decent over, say, a 9-month period, the rest of this year. But it's also just a good 3 to 5 year position if you want to let it run past that. And so you can kind of choose your own time frame, whether you're a trader or an investor.
Then this was a very compelling macro thesis, and also a very good trade. I have to admit that I like it a lot personally, so that's that's really good. If our listeners want to follow more of your thoughts, where can they find you online?
I'm at lynalden.com. I have a free newsletter people can sign up for. I'm also on Twitter at Lyn Alden Contact. Thanks for having me.
Thank you, Lynn, for being here with us.